If you revalue the gold, it makes the balance sheet look better, but in actuality, it isn't. There's $36 trillion in on-balance sheet liabilities, about $30 trillion net. If you revalue the gold, does the debt go away? No. Does it help you access more debt? No. The issue isn't the value of the gold. The issue is the fact that we have $36 trillion in on-balance sheet liabilities and $100 trillion in the net present value of off-balance sheet liabilities.
The global financial landscape is witnessing an intriguing potential strategy by the United States to address its mounting national debt through the revaluation of its gold reserves. The U.S. currently holds 8,133 metric tons of gold, officially valued at $42 per ounce, starkly contrasting the current market price of approximately $2,933 per ounce. This considerable disparity has led some analysts to suggest that revaluing the gold could strengthen the nation's fiscal position by bringing the official gold price in line with market values. Such a move has sparked considerable discussion regarding its potential to improve the U.S. balance sheet and address the growing financial challenges. Throughout history, the U.S. has been willing to take bold, unconventional measures during economic distress. Examples such as the 1933 gold confiscation and the 1971 closure of the gold window highlight the government's readiness to adopt unorthodox strategies when confronted with financial crises. Today, with the national debt exceeding $36.5 trillion, revaluing gold as a solution to address the debt has gained attention. Proponents argue that this could potentially inject hundreds of billions of dollars into the Treasury, improving the government's financial standing. However, whether this approach truly addresses the root causes of the nation's debt issues or serves as a short-term solution. Despite the potential benefits, renowned analyst Rick Rule argues that revaluing gold would be little more than a cosmetic fix, failing to address the deeper, more complex issues underlying the U.S. debt crisis. Rule points out that while revaluing gold might improve the government's balance sheet on paper, it would not reduce the liabilities tied to Social Security, Medicare, and military pensions. Moreover, creditors and pensioners have no direct claim to the U.S. gold reserves, making the revaluation ineffective in solving the country's financial challenges. Even if foreign creditors demanded repayment in gold, the U.S. government holds ultimate authority, rendering such an option unrealistic. We present the clips of Rick's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Interesting question. I think we should have an honest audit of Fort Knox. That gold belongs to Americans. There are serious reservations about whether or not it's there, and if it's there, whether or not it's hypothecated, whether or not it's owed. At Sprott, we had a lot of gold audits. The technology exists to do that. It's not really complicated. 1 bar, 2 bar, 3 bar, sample the odd bar. It's not expensive either. And I think we need to call the question around the political economy in the U.S. And frankly, while that crisis of confidence might not all be a bad thing, I think that the government owes it to the American people to say this gold has been there for the last 50 years, but since there's a popular demand for an audit, we should audit it. Now, the Defense Department has failed their audit. There's been a lot of failed government audits. This one's a little simpler. You count bars and assay them. As I say, Sprott has been doing this for what, 15 years? But I suspect Whitney George would be happy to provide the technology for an audit for free to the U.S. government. Now, revaluing the gold. I think that's a good idea, but it serves no purpose. If you revalue the gold, it makes the balance sheet look better, but in actuality, it isn't. There's $36 trillion in on-balance sheet liabilities, about $30 trillion net. If you revalue the gold, does the debt go away? No. Does it help you access more debt? No, because who can foreclose? The US government owes me, let's say, if I buy some treasuries, the equivalent of 1,000 ounces of gold. So I'm going to pull up an armored truck to Fort Knox and demand payment when the counterparty has an army and nuclear weapons if I get nasty? I don't reckon. It's all theater. The issue isn't the value of the gold. The issue is the fact that we have $36 trillion in on-balance sheet liabilities and $100 trillion in the net present value of off-balance sheet liabilities. Little inconsequential things like Medicare, Medicaid, Social Security, military pensions, government pensions. When people quote the national debt, they quote that $36 trillion number, which is the small one. And revaluing the gold doesn't change any of that because no creditor and no pensioner has access to it. 2, 3, 4 years ago, I filled my boots in the large cap. And frankly, they've done pretty well. Even the laggards like Newmont are up sort of 40%. But the real performers, the Wheaton Precious, the Agnico Eagle, the Lundin Golds, the Alamos, the people that performed, and mercifully I had the good fortune to identify those reasonably well, have done extremely well. And I don't think that they are aggressively priced. Agnico Eagle, as an example, now the world's most valuable gold company. If you look at the cash flow multiple and you look at the balance sheet and you look at the product pipeline, I would say it's fairly valued, but not overvalued. And I think you get any increase in the gold price absolutely positively for free between large multi-asset producers and the smaller companies. Traditionally, this delta gets filled in either because the smaller companies increase in value or because the big companies take over the small companies. The recent takeover of Caliber by Equinox goes right straight to this. Larger companies have more trading liquidity. As a consequence, they have higher market caps and lower cost of capital. They get passive index buying. So there's a natural bias towards larger companies. If you do enough work so that you can identify the better targets, one of two good things happen. It's like the old Pure Later auto filter commercial. You can pay me now or you can pay me later, which is a good circumstance. I also believe, as a consequence in particular of US government debt and deficits, that the gold price goes higher. I see the only way that we have of getting out from under our debt and our off-balance sheet obligations. I see the only political outcome as honoring the nominal value of those obligations, but inflating away the net present value. We did this, Jesse, before you were born, probably, in the 1970s. According to the Congressional Budget Office, the US dollar lost 75% of its purchasing power between 1970 and 1980. Not coincidentally, the gold price went from $35 an ounce to $850 an ounce. So at the same time that I think the big gold companies are reasonably priced and some of the smaller ones are cheap, I think the denominator goes up, which is to say, I think the gold price goes up too.
President Donald Trump recently discussed the potential for tariffs on goods from Canada and Mexico, set to take effect on April 2nd. In an interview on Fox News' Sunday Morning Futures with Maria Bartiromo, Trump mentioned that the tariffs could increase, adding that the temporary delay for these neighboring countries was merely a little bit of a break. In February, Trump announced 25% tariffs on imports from Canada and Mexico. However, these were delayed for a month. After further deliberations, Trump paused tariffs on automakers for an additional month before deciding to delay tariffs on certain goods covered by the USMCA Free Trade Agreement until April. Rick Rule argues that, while politically attractive, tariffs are taxes that can have long-term detrimental effects on the economy. Despite Trump's claims to the contrary, Rule highlights that tariffs, particularly when used as a tool in trade negotiations, can exacerbate inflation and reduce purchasing power, ultimately hurting consumers. Rule also stresses the importance of maintaining positive relationships with international trading partners, suggesting that Trump's winner-takes-all negotiation approach could harm the interconnected North American economy. U.S. auto factories, for example, rely heavily on parts from Canada and Mexico, underscoring the risks of disrupting trade flows. While Canada is not blameless in its trade practices, Rule believes that a more cooperative approach would yield better long-term benefits for the U.S. economy. Let's get back to the video.
Do you see any impact, positive or negative, on that side of things?
Well, being an American, I want to talk about how they might impact Americans first.
Yeah.
Tariffs are taxes, despite Mr. Trump's protestations to the contrary. I believe taxes are bad, all taxes. And so I believe that tariffs are bad. I also believe in a foreign policy that encourages many friends and few enemies. So I get you. I think you understand my drift. Politicians, for me, be they Trump or Trudeau, are to be endured. That's all. This is sound and fury. About 25 years ago, I read a very disturbing book. It was called The Art of the Deal. The author was a guy named Trump. And he talked about the fact that a transaction didn't have two winners, it only had one winner. And the idea was to make your opponent's life so miserable that he or she caved it to you. And I think that's what he's about at present. I don't believe that that's a good way to conduct foreign policy or economic policy. I'm an old-fashioned American. I believe in the Bill of Rights. And I believe that the best government, whichever T, Trump or Trudeau, heads it, is the one that is the furthest from me and leaves me alone the most. Obviously, this was a negotiating ploy. I know that either Mr. Trump or his advisors understand the interconnected nature of the North American economy, the fact that U.S. Auto fabrication plants rely on parts inputs from Canada and Mexico. This is no huge mystery. And everybody knows that Canada isn't blameless either. The shameless subsidies and the shameless protection for the Quebec dairy industry, as an example, comes to mind. It's just that Trump happens to be a more objectionable tyrant than Trudeau. I hope that makes my point of view clear.
Gold is often seen as a hedge against economic crisis, leading some to interpret its record prices as a sign of impending disaster. However, history shows that gold's price peaks reflect existing economic conditions rather than predicting future events. For example, gold's last major surge occurred in September 2011, amid the Eurozone crisis. Similarly, gold's recent rise is fueled by concerns over persistent inflation and geopolitical instability, such as supply chain disruptions and ongoing conflicts. Instead of signaling future collapse, gold's price reflects the current economic and political uncertainties, including the Federal Reserve's prediction of a U.S. economic contraction in 2025. Share your thoughts on Rick's analysis in the comment section below. If you find this video informative, don't forget to support your finance log team and turn on notifications to stay informed about our latest videos. See you in the next video.